Welcome to American Financial Talk. If you're looking for some real clarity in a world of, really complex government rules, dense financial policies, and just confusing benefit structures, you are definitely in the right place.
You certainly are.
Today, we are going to break down some really critical official changes coming in 2026. And these could directly impact your monthly Social Security, your SSI, or your SSDI check.
And we know how overwhelming it can be. You're trying to read through these government pamphlets, and the information seems to change every single year.
It does. So here's the mission for our deep dive today. We want to make sure you never have to worry that a single mistake, maybe in reporting your income, or, unknowingly saving just $1 too much, could cost you hundreds or even thousands of dollars in benefits down the line.
Right. We want to eliminate that stress, that uncertainty, by giving you the precise numbers you need to know for 2026.
And to help us do that, I'm joined by our expert speaker, a retirement financial specialist, with years of experience navigating the fine print of all these rules.
It's my genuine pleasure to be here. The system, it's designed to provide security, but the rules are so intricate.
They really are.
We find that far too many people face financial penalties. And it's not because they're trying to misreport anything, but simply because they didn't know the precise updated dollar limit for their category. These changes for 2026, they're already official. They're locked in.
Already official. Wow.
And for everyone collecting benefits, understanding these exact numbers is, it's your absolute best defense.
We've compiled a stack of highly detailed analysis on this, and it really touches virtually all beneficiaries, whether you're collecting retirement, disability, or supplemental security income.
It really covers the whole gamut.
It does. And if this deep dive provides that clarity and insight for you today, please do us a favor. Hit that like button, share this information with a friend or a neighbor who needs it, that friend on disability, or your cousin who just started taking early retirement. And of course, subscribe to American Financial Talk.
Your support really does allow us to keep bringing you these essential updates year after year.
It absolutely does. Okay, let's unpack this. We're going to start with, I think, the most common area of stress and confusion. And that's for the millions of people who are still working while receiving early retirement benefits.
This is a big one.
It is. This is the retirement earnings test. It's a hurdle that applies only if you are under your full retirement age, or what they call FRA, and you choose to take Social Security benefits early.
Right. And if you're already at your FRA, good news for you. You can probably skip ahead a few minutes. We have some great news for you later on.
We do. But for everyone else still navigating those early retirement years, this test is where most people get tripped up. So let's look at the three distinct groups affected by this earnings test in 2026.
Okay, let's start with the first one. This is by far the largest group subject to the test. This rule applies to people who are generally between the ages of 62 and 66. And they're receiving benefits, but they will not reach their full retirement age at any point during the 2026 calendar year. So if you're staying under your FRA for that entire year, this is your number.
This is the one to write down.
This is the one. For 2026, the key number you must write down is $24,480.
Okay, $24,480 for the whole year.
For the entire year. You can earn up to that amount from a job, a side gig, self-employment, anything, without any reduction at all to your monthly Social Security check.
So just to make that a little more digestible for people who are budgeting monthly, that's roughly $2,040 a month.
That's right.
But here's the crucial question that I think a lot of people have. How does the Social Security Administration, the SSA, actually track this? What if someone gets an unexpected bonus or a quarterly payment that makes 1 month look way higher? Do they just penalize you for that 1 month?
That is a fantastic practical question because it's a real world problem, right, for consultants or seasonal workers. The good news is that for this category, the SSA looks at your total annual earned income. So they average it out. However, and this is important, initially, the SSA needs to estimate your earnings.
Okay.
So if you tell them you expect to earn, say, $20,000, but then in July you get a surprise $10,000 bonus, well, suddenly you're over the limit. The SSA will start withholding benefits almost immediately based on that reported or projected earnings spike.
So that $24,480 number really is a hard ceiling.
It is your hard ceiling. If you go over it, the SSA starts reducing your benefits. And specifically, if you earn over $24,480, Social Security reduces your benefit by $1 for every $2 you earn above that limit.
1 for 2.
That 2-to-1 ratio adds up really, really fast.
Okay, let's run a clear example just to solidify that math for everybody listening. Let's say someone earns $34,480 in 2026. That's exactly $10,000 over the limit. What's the precise financial impact there?
Okay, so you've earned $10,000 over the limit. Social Security will take that $10,000, they'll divide it by 2, and the resulting penalty is $5,000.
$5,000. Wow.
That means $5,000 of your total annual Social Security benefit will be withheld over the course of the year. So, for example, if your check is, say, $1,000 a month, they might just withhold your benefits for 5 entire months to get that $5,000 back.
And that sounds terrifying. When you hear about benefits being withheld, it can cause a real temporary financial shock. But this is the critical piece of insight that I think relieves so much worry for working early retirees.
Yeah.
That money, it's not actually a permanent fine, right? It's not a penalty in the traditional sense.
Exactly. This is the huge distinction between the retirement earnings test and the disability rules that we're going to cover later. When the SSA withholds these benefits from an early retiree, they are not permanently taking your money.
They're just holding on to it.
They're simply delaying payment. They view this as benefits that you weren't quite fully eligible for yet because you went over that earnings test.
Okay, so what happens to it?
Well, once you reach your full retirement age, the SSA will recalculate your entire benefit amount, and they give you credit for the money they withheld. It's called an actuarial increase.
I see.
Essentially, the money is paid back to you, but slowly, over time, through slightly higher monthly checks for the rest of your retirement. It's almost like an interest-free loan they pay back to you later.
That realization that the money isn't lost forever, but it's just deferred. I think that's the key takeaway for so many people who are just terrified of over-earning.
It is.
But as you said, careful tracking is still critical. You have to budget for that temporary drop in your monthly check now if you think you're going to be working anywhere close to that $24,480 limit.
You absolutely have to.
Okay, let's talk about change number 2. This is for I guess a fortunate subset of our listeners. These are the people who are currently getting benefits, but who will turn their full retirement age sometime during 2026.
Right. This group gets a completely different rule book for the year. The rules are significantly more generous.
How so?
Because the SSA understands you're almost at that point of unlimited earning freedom. So for this specific category, the annual limit jumps dramatically. It goes all the way up to $65,160.
Wow, $65,160? That's nearly triple the limit for the younger group.
It's a huge jump.
That provides a wonderful financial runway for those last few months of early retirement. But as we discussed, there's a very strict rule here about the timing, right?
That is the essential fine print. This high limit applies only to the months leading up to the month you reach your full retirement age. As soon as you hit your FRA month, poof, the limit disappears entirely. Your earnings from that month forward are unlimited.
Okay, so let's use a clear example for that. If my full retirement age birthday is in October of 2026.
Okay, great example. The $65,160 limit applies only to your earned income from January through September.
Just those 9 months?
Just those 9 months. All the money you earn in October, November, and December is completely excluded from the earnings test calculation. This allows people, say, turning 67, to really maximize their income in that final year of working without a penalty, as long as they don't go over that generous $65,000 ceiling before their birthday month.
And if this group does manage to go over that $65,000 limit in those pre-FRA months, is the penalty also softer?
It is, absolutely. The government eases up on the reduction here, too. For this group reaching FRA in 2026, the reduction is only $1 for every $3 earned over the limit.
So 1 for 3 instead of 1 for 2.
Exactly. A much better deal.
So we have a higher limit and a softer penalty. To illustrate that, if this person earns, say, $900 over the $65,000 limit during those pre-FRA months, the reduction is only $300 to their benefit.
Correct. Only $300. It's a powerful incentive to keep working right up until that crucial birthday month.
Seems like it.
And just like the other category, any money withheld here is also eventually paid back after you hit FRA through those same higher monthly checks. The system is essentially encouraging you to ramp up your earnings right before you transition into that unlimited earning phase.
That makes perfect sense. All right, now for the absolute best news regarding working and retirement benefits. Let's clarify the rule for anyone who is already at or past their full retirement age going into 2026.
This is the freedom milestone. It's what everyone is working towards. If you are already at your full retirement age going into 2026, or if you hit your FRA in 2025 or any year before, the earnings limit is 0.
0.
There is no earnings test applied to you. None.
So the implication of that is the simplest and most liberating of all the rules.
It really is. You can work as much as you want. You can earn unlimited income, a salary, contract pay, profit from a business, and your Social Security retirement check remains completely untouched.
You don't even have to report it to the SSA.
You do not have to report your earned income to the SSA for this purpose. There are no reductions, no penalties, and absolutely no risk of getting one of those overpayment letters regarding your earned income. This is the crucial point for anyone who needs or wants to keep working full-time.
That level of clarity and freedom is exactly what the system is designed to provide once you reach that specific age milestone. Okay, let's transition now. We're going to go from retirement benefits, where the money is deferred, to disability benefits, where the rules are entirely different and, well, much, much stricter when it comes to working.
A completely different world.
When we discuss SSDI, Social Security Disability Insurance, we're talking about benefits based on a person's past work history and their medical inability to perform what's called substantial gainful activity.
Right.
And unlike the retirement rules, exceeding these limits can jeopardize the core benefit itself. It can lead to a permanent loss of eligibility. And that distinction between a temporary withholding and a permanent loss is just vital.
It is absolutely vital. You said it perfectly. For retirement, working too much is a financial optimization problem. For disability, working too much is an eligibility problem. The SSA defines disability as being unable to engage in substantial gainful activity, or SGA. So if you prove you can engage in SGA, you are essentially proving you're no longer disabled under their definition.
You're proving their case against you in a way.
You really are. So let's talk about the first disability group. This is for non-blind SSDI beneficiaries.
Okay.
The number you need to memorize for 2026, if you're a non-blind SSDI recipient, is $1,690 per month.
$1,690 a month.
$1,690 a month. This is the critical threshold for your earned income. This is the gross income you get from working a job or running a small business, and it excludes your SSDI benefit itself.
So $1,690 is a hard line in the sand. Now, what if a beneficiary is working intermittently, maybe as a contractor, and they get a lump sum payment that puts them at, say, $3,000 for 1 month? Does the SSA look at that strict monthly limit, or is there any kind of flexibility, like a quarterly average?
That's an excellent practical question. For SGA determination, the SSA primarily looks at your monthly earnings, but they do have rules that account for how the services were performed. Generally, if you're self-employed or a contractor and you have a sudden spike, you need to be able to show that that large payment was either for work performed over multiple months.
Oh, so you can spread it out?
You can ask them to average it out, yes, or that you have significant impairment-related work expenses that can be deducted from that gross income. But if you have sustained single-month earnings above $1,690, you are inviting immediate scrutiny.
What is the consequence of earning more than $1,690 a month, even just temporarily, if those deductions or averaging rules don't apply?
The consequence is severe. Earning more than that is considered engaging in substantial gainful activity, and it signals to Social Security that you may no longer meet the statutory definition of disability.
So what happens then?
Well, the SSA does have some rules that allow for a trial work period. It's 9 months where you can kind of test your ability to work without immediately losing benefits. But once that period is used up, continued SGA can lead to your benefits being stopped or reduced permanently. And the worst part is that the SSA often takes months or even years to catch up to this. When they do, they look back at all the months you went over the limit and they send a devastating, unwelcome
The overpayment letter.
Demanding that you pay back thousands of dollars to the government all at once.
That's the financial nightmare we're trying to help people avoid.
Okay.
So the practical advice here is absolute. $1,690 per month is a hard maximum you have to avoid risking.
If you get close, you need to slow down your work schedule or be prepared to use every possible deduction for impairment-related work expenses to bring that countable income down.
Okay, now let's look at change number 5. This one affects blind SSDI beneficiaries, and there is a huge difference in the earning threshold here.
That's correct. The SGA earnings limit for blind SSDI beneficiaries is substantially higher. For 2026, that threshold is $2,830 per month.
2,830. What's fascinating here is the massive difference. It's over $1,100 a month more than the non-blind threshold. Why does the SSA allow for that specific difference?
This difference is critical, and it's actually rooted in federal law. The higher threshold legally recognizes two key realities. First, people with visual impairments often face greater difficulty and discrimination in securing stable, well-compensated work.
That makes sense.
And second, working while blind often involves necessary, expensive, non-reimbursable costs. Things like specialized transportation to and from work, adaptive technology, maybe the cost of a reader or an assistant. The SSA essentially acknowledges that a higher level of gross income is required for blind individuals just to maintain the same net standard of living.
I see. So it's an acknowledgement of those extra costs.
It is. However, the severity of exceeding this threshold is exactly the same. If you are a blind beneficiary and you earn more than $2,830 per month, Social Security will begin questioning your disability status. And that leads to the same outcome: potential benefit elimination, garnishment, and those painful overpayment notices.
So the actionable step here is crucial. If you're receiving SSDI and you are unsure which category, blind or non-blind, your benefit falls into, you have to call Social Security and confirm. Don't guess.
Please do not guess. The difference between $1,690 and $2,830 is enormous for your budget, but exceeding the wrong limit leads to the exact same painful result.
So just to recap that point. For retirement, working too much results in a temporary loan you get back later. For disability, working too much is crossing a gate, and it can lead to losing your eligibility entirely.
That's the perfect summary.
Okay. We've covered retirement and disability. Now let's move to supplemental security income, or SSI. This program is means-tested, designed for low-income seniors and people with disabilities who have little to no work history, and is really characterized by small payment increases and often frustrating stagnated limits on savings.
That's right. SSI is a need-based program. So unlike Social Security Retirement or SSDI, which are insurance programs based on your past contributions, SSI requires that you demonstrate limited resources and income.
Right.
And this means the benefit goes up slightly because of inflation, but the asset rules remain, well, brutally strict.
Let's start with a slight increase in the maximum payment. What's the new ceiling for an individual?
The maximum monthly federal benefit for an individual on SSI is rising from $967 in 2025 to $994 in 2026.
Okay, so that's an increase of $27 per month.
$27. It reflects the cost of living adjustment, or CBLA, that we'll detail shortly. For someone who depends on this income, an extra $27 a month is certainly welcome, but, it barely keeps pace with inflation, especially for things like housing and food costs.
It really doesn't. Now, we have to talk about the critical sticking point that generates so much anger and stress in the SSI community: the asset limit. What is the limit for 2026?
This is the major financial frustration in the entire benefit system. The asset limit remains unchanged for 2026. It is sitting tight at just $2,000 in countable resources.
$2,000. And that's been the same for a long time.
A very long time. And countable resources include cash, money in checking and savings accounts, stocks or bonds. Things like your home, one vehicle, and your personal possessions are generally excluded.
$2,000. I need to put that number into perspective. That limit has basically been fixed at this level for decades, hasn't it? If that number had just been adjusted for inflation since the early 1980s, where would it be today?
Oh, it's a shocking number. If the $2,000 asset limit had simply kept pace with inflation since 1989, that limit would need to be well over $5,000 today just to have the same purchasing power.
Wow.
The fact that it remains fixed at $2,000 creates what economists call a profound poverty trap.
A poverty trap. Explain that.
Well, the implication is this. While the monthly benefit inches up to $994, the resource limit actively prevents beneficiaries from saving money for any kind of emergency. If an individual saves $2,001, they immediately lose their eligibility for the benefit and for Medicaid until they spend that money down.
So if a recipient gets an unexpected $1,000 from a relative for Christmas, or maybe a $500 insurance payout for a broken bone, they have to immediately spend that money to get back under the $2,000 threshold. Otherwise, they risk losing their entire monthly income and their health coverage.
Precisely. This stagnation effectively forces people to live paycheck to paycheck. It prevents them from achieving any form of financial resilience. They can't build a buffer for an unexpected car repair, a security deposit on a new apartment, or medical supplies that Medicaid might not cover. They are perpetually forced to spend down any small gain.
And that's a huge policy issue that these 2026 changes just completely failed to address.
Completely ignored.
Let's look at married couples on SSI. Change number 7 also shows a slight bump in the maximum monthly payment, but again, with the same stagnant asset issue.
That's right. The maximum monthly benefit for a married couple is rising from $1,450 to $1,491 per month in 2026.
So that's an increase of $41 per month combined.
$41 combined. And critically, the asset limit for married couples remains unchanged at $3,000.
Still just $3,000.
And that limit applies to the combined countable resources of both spouses.
This brings us back to that persistent question about the marriage penalty. For the sake of clarity, since these dollar amounts have changed a little, can you confirm that the penalty is still in place for 2026?
Unfortunately, yes. The marriage penalty is still very much in place within the SSI rules for 2026. And the financial loss is just obvious when you look at the numbers.
Break it down for us.
Okay, the maximum benefit for a married couple is $1,491. But if two individuals live together but were not legally married, they could each potentially receive the individual maximum of $994.
So that's a total of...
A total of $1,988 per month.
Wow. That's a difference of nearly $500 a month in potential income, just because they're married.
It is. The SSA assumes that couples share resources, and so they require a significantly smaller combined benefit. This creates an enormous disincentive for low-income seniors who depend on SSI to formalize their relationships. It forces them to prioritize financial solvency over marriage, which is a serious ethical and practical dilemma.
It's a harsh reality that has persisted across decades of policy adjustments. Thank you for making those numbers so clear.
Of course.
Now we're going to pivot slightly and look at the financial infrastructure of the entire system. This next section covers eligibility for future retirees and the impact on contributions from high earners right now.
Right. So change number 8 involves the very foundation of eligibility, quarters of coverage, or as most people call them, work credits.
Work credits, right.
To qualify for Social Security retirement benefits, and assuming you're at least 62 years old, you absolutely must have 40 work credits. That translates to about 10 years of working and contributing to the system, and you can earn a maximum of 4 credits per year. In 2026, the dollar amount required to earn those credits is rising. It's tied to inflation and rising wages. The amount needed to earn just 1 credit has increased by $80, so now it requires $1,890 in earned income per quarter.
So if you're looking to earn the maximum 4 credits for the year, what's the minimum total income you need to make in 2026?
To earn the full 4 credits for the year, an individual has to earn a minimum of $7,560 total in 2026.
$7,560.
Right. And importantly, you don't need to earn that $1,890 in the first 3 months, then another $1,890 in the next 3, and so on. The SSA looks at your annual income. Once you hit that total of $7,560, you've maxed out your 4 credits for the year, regardless of when you earn that money.
Okay, that's good to know.
Earning more than that only affects your future benefit size, not the credit count itself.
So why does this small change in the required earnings matter so much? I mean, especially for people who may have worked a steady career. Who is this most relevant to?
This change is tremendously relevant to the margins of the workforce. We're talking about several groups here. First, older people who took time out of the workforce to raise children and are now trying to get those last few crucial credits before they can retire.
Right, I know a lot of people in that situation.
Also, new immigrants or younger workers just trying to establish a work history. And third, anyone who is piecing together part-time work or running very small side businesses that might generate inconsistent income.
So for them, every dollar counts.
Every single dollar earned builds toward these crucial credits. If you fall short of that $7,560 total for the year, you might only earn 3 credits, or 2, or 1. If you have gaps in your work history, this rule is about ensuring you're even eligible down the line. Missing a credit permanently extends the time you need to work to qualify for benefits at all.
That's a great clarification. Okay, change number 9. This is the maximum taxable earnings cap, often called the wage cap. And this one affects contributions to the system and is really only relevant to high earners.
That's right.
This change affects a small percentage of the population, probably only 5 to 10%, but it does matter for the funding of the entire system.
It does. This is a change about who pays and how much they contribute. For 2026, the maximum amount of income subject to the Social Security payroll tax is rising from $176,100 in 2025 to $184,500 in 2026.
Okay, 184,500. Let's break down the mechanism and the impact for those high earners.
Sure. It means that all income from the very first dollar up to $184,500 is subject to the Social Security payroll tax. That's that 6.2% you see coming out of your paycheck.
Right.
Any income earned above that new threshold is exempt from the Social Security tax. Now, it's still subject to Medicare tax, but not Social Security tax.
So what's the immediate impact?
The immediate impact is that high earners will pay Social Security taxes on an extra $8,400 of their income in 2026 compared to last year. If they're employees, they'll pay 6.2% on that extra amount. If they're self-employed, they're on the hook for both the employee and employer portions, meaning they pay the full 12.4% on that extra $8,400.
So if we connect this to the bigger picture, the narrative often revolves around the solvency of the Social Security trust funds. Does raising the cap by $8,400 significantly impact the system's long-term financial health? Or is this just a standard annual adjustment?
You know, the source material we looked at suggests this is really just a drop in the bucket regarding the large structural solvency issues facing the system.
So it's not a fix.
It's not a fix. While the money certainly helps and it increases the total revenue flowing into the trust fund, this adjustment alone is not going to solve the long-term financial needs. It's an adjustment based on the average increase in wages, which is the statutory mechanism for how they calculate the cap.
Yep.
For self-employed individuals, this just means they need to adjust their estimated quarterly taxes to account for that higher wage base. But for the vast majority of our listeners who are retired or working at middle income levels, this change is relevant conceptually, but it's not going to touch their finances directly.
Good clarification. It's important to understand where the money is coming from, and that these small annual adjustments don't substitute for large-scale reform.
Not at all.
All right, this next section is the one every single person collecting Social Security retirement, SSDI, or survivor benefits is waiting for. It is the cost of living adjustment, or COA, and the crucial offset that comes with it.
This is the one that gets all the headlines. Change number 10 is the big one. The official COLA for 2026 is 2.8%.
2.8%.
Right. This adjustment is calculated based on changes in the Consumer Price Index for urban wage earners and clerical workers, or CPIW. It's a specific measure of inflation that tracks costs commonly experienced by working families. The goal is just to ensure that the purchasing power of your benefits doesn't erode because of rising prices.
Okay, and we need to be crystal clear on the effective date here. When exactly does that 2.8% increase show up in the checks that people receive?
The increase is always applied to benefits in the new calendar year. That means it goes into effect in January of 2026. This causes confusion every single year.
Every year.
People check their December benefit, and they wonder why it hasn't changed. The increase is applied to the January payment, which typically arrives in your bank account or is delivered by mail in early to mid-January, depending on your birth date. You have to wait for that first check of the new year.
Got it. Now, you mentioned a little-known but very beneficial fact about the COLA that affects people who are eligible but haven't actually claimed their benefits yet. This is a powerful feature that really rewards patients.
It really is. This is one of the system's best hidden benefits.
So can you detail how that behind-the-scenes adjustment works?
Certainly. Even if you're eligible for Social Security, meaning you're at least 62 and you have those 40 credits we talked about, but you are not yet collecting benefits, the COLA is still applied to your benefit calculation behind the scenes every single year.
So it's growing even if you don't see it.
It's growing in the background. What this means practically is that every year you delay claiming, your base benefit grows not just from your delayed retirement credits, but also from the compounding effect of the COLA.
That's amazing.
So if you decide to wait until age 70 to claim, the cumulative effect of all the past COLAs since you turned 62 are already baked into your final monthly payment. This helps your delayed retirement credits grow even faster, securing a significantly higher monthly check for the rest of your life.
Okay, now for the critical counterpoint. The vital bonus change, number 11. We have to warn everyone that the Medicare Part B premium is increasing for 2026. And this is the often overlooked cost that automatically offsets that COA increase.
This is the reality check that every beneficiary has to prepare for. For the majority of Social Security recipients, the Medicare Part B premium is not paid separately. It is automatically deducted from your gross monthly Social Security check before that money ever hits your bank account.
So what does this all mean in terms of the actual money hitting your bank account in January? What is the net reality of that 2.8% COLA?
Well, even though you are officially getting the 2.8% COLA applied to your gross benefit, the Medicare premium hike is going to eat into it, as you said.
Right.
Since that deduction comes out first, the resulting net increase in your actual take-home check will be smaller than the 2.8% increase suggests. Beneficiaries have to be prepared for that reality. You should not expect a full 2.8% boost in your bank balance in January. It's crucial to look at the net number.
Can you give us a quick example of that?
Let's use a simple hypothetical calculation to make this concrete. Let's say the 2.8% COLA results in a $50 increase to your gross monthly benefit. But let's also assume the new Medicare Part B premium increases by $15 per month. Your net gain is only $35. That $15 isn't lost, but it offsets the perceived gain from the COLA. Understanding that offset is key to managing your budget and avoiding disappointment when that first 2026 check arrives. You have to factor in the Medicare hike when you adjust your monthly spending plans.
That is fantastic practical context. We've covered 10 official changes plus the Medicare offset. Now let's wrap up this deep dive with a clear, jargon-free action plan for the listener, ensuring they know exactly what to do next based on their specific situation.
Sounds good.
The main goal of this deep dive is to prevent stress, overpayment notices, and lost benefits. Given the sheer volume of numbers we covered, 24,000, 1690, 2,000, we need to triage this action plan. We need to focus people on only the numbers that matter to them.
Right. The first step is to focus. And the most basic yet most often overlooked step is to identify and write down your specific numbers. Don't try to memorize all 10 numbers we talked about.
Just the ones that apply to you.
Just the ones that apply to you. Your triage process starts right there. First, identify your status. Am I an early retiree who's working? Am I on SSDI? Am I on SSI? Then, and only then, record the 2 or 3 numbers that matter most to you for 2026.
So if you're an early retiree and working,
Your number is $24,480. If you're on SSDI, your number is $1,690 or $2,830. If you're on SSI, your resource limit number is $2,000 or $3,000. Keep these few numbers visible. Put them on a sticky note, a whiteboard, in your digital notes. These are your red lines for 2026.
that visibility prevents accidental overages. What's the next essential step, especially for those working close to the limits?
Step 2 is to track your income carefully and continuously. Don't wait until the end of the year, in November or December, to realize you've blown past your earnings limit.
Don't get that holiday surprise.
Exactly. Ongoing monthly tracking is essential. This continuous tracking prevents those huge spikes in income that cause massive benefit reductions and that dreaded stressful overpayment notice months later. If you track monthly, you can adjust your work schedule, you can slow down, or stop working temporarily to stay safely under the cap and maintain control.
Great advice. For those on need-based programs like SSI or SSDI, the small benefit increases we discussed barely cover basic costs. Are there other non-cash programs they should investigate?
That leads right to step 3. Explore other programs to maximize your resources. If you're on SSI or SSDI, your income bracket often automatically qualifies you for other programs designed to stretch your money further.
Like what?
Call your local government or health agency and check your eligibility for SNAP food benefits, for Medicaid, for programs offering extra help with prescription drug costs. That's the Part D low-income subsidy and state utility assistance programs that help with heating and cooling bills. These benefits can often provide much greater financial security than the small benefit increases we discussed.
And finally, what about those tricky situations where someone is unsure of their specific status, or they're dealing with a complex issue like a small inheritance?
Step 4 is to call Social Security for clarity. And yes, we know the wait times are often brutal and frustrating. We hear it all the time.
They are long.
But getting clarity on specific categories like confirming your blind versus non-blind status for SSDI, or understanding exactly how a lump sum payment or a small inheritance affects your $2,000 SSI resource limit is absolutely worth the effort. It is far better to wait on hold now and get the correct information than to receive a surprise bill from the government later that throws your entire budget into chaos.
That is great advice. We have one final time-sensitive reminder. regarding Medicare enrollment. Who needs to pay attention to this right now?
This is a specific warning for listeners who are turning 65 in January, February, or March of 2026.
Okay, so if your birthday is early next year.
The reason for the urgency is that your initial Medicare enrollment period begins 3 months before your 65th birthday month. So if your birthday is in early 2026, you should be researching, preparing, and enrolling right now.
Don't wait.
Do not wait. Getting the timing or the plan wrong can result in costly gaps in coverage, permanent late enrollment penalties to your Part B premium that lasts for life, or simply being on the wrong plan for your medical needs and your budget. Do not wait for the last minute on this complex process.
Enrollment mistakes are notoriously expensive and complicated to fix, so thank you for that timely warning.
You're welcome. And to conclude this deep dive, knowledge is your primary defense against complexity and financial stress. Millions of people successfully navigate the system every year. The key is simply knowing the rules, the exact dollar limits that apply only to you, and staying informed about annual adjustments like the ones we've covered today. This has shown you the most critical rules and numbers for 2026 across all categories.
It really has.
And this raises an important question that I want every listener to think about as they finalize their budgets for 2026. Given the persistent stagnation of the SSI asset limits at $2,000 and the fact that the Medicare premium is set to consume a portion of the COLA, how should you adjust your monthly budget right now to ensure financial resilience throughout 2026? Are there cuts you can make or programs you can access to absorb those rising costs?
That is a thought worth carrying forward. Thank you for guiding us through these complex yet essential 2026 updates with such clear and practical advice.
My pleasure.
And thank you for joining us for this crucial deep dive into your 2026 benefits. If this information was valuable, please hit that subscribe button and most importantly, share this with your circle, your mother, your neighbor, your friend on disability. They need this information too, and sharing it makes a real difference in preventing financial harm. Take care of yourself and take care of each other.